How to reduce your monthly mortgage payment? Want to know more tips and tricks with regards to real estate financing? Let's roll right straight into it. Hi, I'm Vincent Jen from OrangeTee Tie. Welcome to Property Made Easy online series episode 4. Tips and tricks of real estate financing. If you don't already notice that the Sibor, Singapore Interbank offering rate, has come to a really low level now, let's check out this chart. The 1-month Sibor rate is now at 0.25%, while the 3-month Sibor rate is at 0.55%. Just for information, the lowest 1-month Sibor rate was at 0.19% back in August 2011. Due to current situation of COVID-19 pandemic taking place worldwide, the Sibor rate has fallen sharply from 1.88% same time last year to 1.75% January this year. The current Sibor rate is at 0.25%. So what's in it for you? Let's create an example for demonstration purpose. Kelvin has an outstanding housing loan of $500,000 with 18 years loan tenure left. His current interest rate is 2.5% and he's paying about $2,877 a month. Let's assume, if Kelvin were to refinance his housing loan to interest rate of 1.65% for the first 3 years, he only needs to pay about $2,677 a month, a difference of about $200 a month, $2,000 for a year, and $7,200 after 3 years. So is it worth the effort for Kelvin to do the refinance? Kelvin gets to save $4,200 in 3 years after all the costs, like legal fees and variation fees counted in. However, in the same scenario, if Kelvin only has an outstanding loan amount of $300,000, he only gets to save $1,320. Is it still worth refinancing? Another reason why people refinance is to stretch the loan tenure. It reduces the monthly mortgage repayment. Taking a new loan, if you were to get a maximum loan to value ratio, say 75%, you can only loan up to 30 years. However, when you refinance, you are able to stretch loan tenure beyond 30 years. This reduces your monthly mortgage payment. The loan tenure is 75 years minus age of borrower, or 35 years minus number of years of loan taken, whichever is lower. Ryan is 38 years old now, who bought a property 3 years ago, loan tenure 30 years and loan amount $800,000 at interest rate of 2.6%. If Ryan does not refinance his housing loan, his monthly installment will be $3,202, of which $1,614 goes towards interest payments. If he were to stretch his loan tenure, Ryan can stretch his loan tenure to 32 years. With the lower interest rate at the same time, 1.6%, Ryan needs to service his next monthly mortgage at $2,475 only. If loan tenure is maintained without stretching, Ryan needs to service his next monthly mortgage at $2,827. One of the reasons to increase loan tenure is to lessen cash flow burdens as monthly mortgage payments are lower with a longer loan tenure. Another reason, which is pretty commonplace, will be to allow our clients to qualify within the TDSR criteria when purchasing their second, third or subsequent properties. A lower monthly mortgage payment will help our clients to maintain a 60% TDSR. Essentially, the decision to refinance or otherwise very much depends on the borrower's individual situation. Do bear in mind that refinancing will restart and/or prolong the amortization of the mortgage loan. And furthermore, the initial interest repayment is high, although the weightage of this gets shifted towards principal repayment during the course of the loan. Therefore, I would strongly encourage you to speak to a proficient agent or banker, or they will weigh the pros and cons of refinancing based on your specific situation and needs. Thank you for watching. In my subsequent episodes, I will be touching further on mortgage equity withdrawal loans and asset under management financing. It can assist your real estate journey to be smoother, safer, and more profitable. Do follow us on all our social media channels and remember to like and subscribe. Once again, I'm Vincent Jen. See you next episode. Bye bye.